If you've ever wondered, should I put my money in a Roth IRA or 401k, you're not alone. One gives you a tax break now, one gives you tax-free money later, and picking wrong can cost you thousands in retirement. In the next few minutes, I'll show you a simple way to decide, how to stack them for maximum growth, and a quick rule you can apply today for your retirement plan, even if you're just now getting started. So, welcome to the channel. I'm Dexter, and here we cover strategies and tactics to help you get better at managing your money. So, we've got two powerhouses today, folks, when we look at our retirement accounts. Now, most people would have you think that the main debate just comes down to taxes, but they're wrong. There are several other factors that are at play here, one being flexibility, another one being contribution limits, another being, hey, free money, legacy impact, and more. We're going to step through all of this here, starting with the 401k. And why the 401k? What's some of those benefits about having a 401k? So the first one that jumps off for us is that match, right? The employer match. That's where you can get 50 to 100% instant return on your money. So let's walk through an example of what this could really look like. We have two folks here that's contributing to their retirement plan. We've got Brian, whose employer matches 50% of his contributions up to 6% of his salary. And we've got Sarah, whose employer matches 100% of her contributions up to 6% of her salary. So from Brian's standpoint, salary $60,000, he's contributing the 6% up to the match. So that means he's contributing $3,600. His employer, they are going to match 50% of that, so they're going to contribute $1,800. So combined, his total contributions for that year is $5,400. Now that's a 50% instant return on his money that Brian is getting, right? So that's really, really good. Now that's before the market kicks in. Now on the other hand, Sarah's employer contributing that 100%, her salary is $60,000. Her contributions are $3,600. Her company, her employer is going to match that at 100% up to that 6% level. That means the employer is contributing $3,600 as well. So her total amount is 36 plus 3,600. That's 7,200 for her year. That's 100% instant return before the market kicks in. So the kicker here is that's free money. That's that main, the first pro here, the benefit of having it. So make sure you contribute enough to get that free money, right? So let's step through some other pros, some advantages of having that 401k. One being, hey, tax break now, right? So if these are your high income years when you're working, so you're getting tax break on that money now. Secondly, there's no income limit, right? So you can contribute if it's $25,000 or $520,000, right? So there's no income limit around contributing to the plan. Also, you have access to loans. A lot of plans have access. You can go out, you can take, withdraw some of your money from a loan standpoint. Typically, it's the lesser of 50% of your vested balance or $50,000, the lesser of those two from a loan standpoint. Now, with that loan, you would be paying yourself back interest you got to consider. You also have fees to consider. Another drawback there that people don't think about sometimes is that that's money out of the market that you pulled out that could be compounding and working for you. So that should be looked at as a last resort there when you're thinking about that loan, because you're giving up some positives there. And then also you have high contribution limits. So if you're less than 50, that's $24,500. If you're 50 or above, there's some catch-up contributions there that can be had as well. Now, some of the cons, they're again paying taxes in the future on those future withdrawals, not knowing what your tax is going to be, so that's a con. Another one is limited investment options. Some of these plans out here do not have robust options, so that means you may not be into the best funds or ETFs and et cetera being offered, so you have to consider that as well as you think about one of the possible cons. Another one is if access to your money from a withdrawal standpoint, you need to be 59 and a half years old or older in order to access your money penalty free. You're still going to pay taxes on it, but in order to avoid that 10% penalty, except for special circumstances, right? And that sort of thing. Another one is that required minimum distribution will kick in. That's where the government's going to force you to start pulling your money out. The current age is 73. in the year 2033, that increases to the age of 75. And you may be wondering why. And that's because, hey, you've avoided taxes on that money, and the government's like, hey, we need to start getting our money out at some point here. And they've got a table or a formula that helps identify what that amount is that you've got to contribute, that you got to pull out, such that they can start taxing you accordingly, right? And then finally, any of those withdrawals there could put your income in a higher bracket, where your modified adjusted gross income increases, where now your IRMA, your Medicare premium, is now impacted, right? So those surcharges that you pay for Medicare could increase. That's another con from having that 401k withdrawal. So those are some of the pros, benefits, and cons as you think about from a 401k. Let's move over now to a Roth IRA. Now, from a Roth standpoint, as we think about these taxes, that's what your contributions are with after-tax money, right? So it's coming out, net paycheck after you've already paid taxes. So that money is after tax that's contributed. So no taxes on future gains. So that's tax-free growth. When you withdraw, this tax-free, provided that you've had it open and contributing for 5 years, and you're 59 and a half years old when you start pulling that out, unless there's some special circumstances there. But also, there's no mandatory RMDs, no required minimum distributions. You also have no IRMA impact. So your withdrawals do not impact MAGI, your modified adjusted gross income, right? They don't. So that's another benefit there. And also from an inheritance standpoint, your heirs, they do not have to pay any taxes on that money. So that's strong considerations from a pros as we think about versus the 401k. Now from a con, there's some contribution limit here, which is a lot lower than the 401k. This year is $7,500, $1,100 catch up if you're 50 plus years old, taking that maximum contribution there up to $8,600 for 50 plus. Another con is that you do have some limitations to participate from an income standpoint. So if you're modified adjusted gross income, if you're single, if you're 153, it starts to phase out. 153,000, it starts to phase out. If you're married, filing jointly, that starts to phase out at $242,000 modified adjusted gross income. So those are some of the cons there as you think about that Roth rate. Now, how do we really want to approach these to have your ideal setup from a retirement standpoint? First, recommendation would be, hey, let's contribute enough to get the match, right? And then once we've done that, then let's go after that Roth if we're eligible. We just saw some eligibility requirements there. So if you are eligible, then we want to go ahead and max out that Roth. And if we have some money left over, go back and contribute to that 401k. We want to try to maximize and maximize those savings, maximize call it your tax benefits as well. Now, if either of those, you've maxed out those, you still have money left over, you want to contribute to a retirement plan, that's where you need to open up a brokerage account and start contributing there, right? So that's the play there. And how this would look, let's say we have, example here, Emily, young in career, 27, and with that younger career, have a lower salary, call it 70,000, where her plan is going to contribute to the 401k to get that match. Then put $500 a month into a Roth. She's got some extra cash there, and over time, she's going to increase her contributions to a 401k up ideally from 10% up to that 15% level there. That most, if you think about financial professionals, recommend you get to that 15% contribution to your salary. Whereas we've got James, example number 2, mid-career, higher salary. His salary is such that he supersedes, he can't contribute to the Roth IRA. So what he's going to do, he's going to max out his 401k. And if he's got any additional funding, then he's going to contribute to his company Roth 401k. So companies these days, they have regular 401k and a Roth 401k. A lot of them do. So he's going to then start contributing to that Roth 401k. Now, ideally, if he can't, he does have an option of doing what's called a backdoor Roth IRA. He's got to consult with a professional in order to execute and make this happen, in order to make sure that no tax implications and that sort of thing. So those are some options that James has got. So this is how we would look at, 401k versus a Roth IRA. Ideally, we want to participate in both. It's just really from a timing standpoint and a contribution amount standpoint, right? So we want to take the best of both worlds as we think about building out our retirement plan, because that's when we win in the future, right? So if you found this information helpful, give this video a like, subscribe to the channel, and share this information with someone that can benefit. Until the next video.